Hello and welcome. Today we dive into the turbulent waters of the U.S. markets, exploring the bold moves and sharp insights of one of the most influential investors of our time, Bill Ackman. It's chaos out there. The U.S. markets are in turmoil. A new tariff war has erupted, and President Trump's aggressive trade stance is shaking global confidence. Some experts are now calling this the early stages of an economic nuclear winter. Inflation fears are back, stocks are plunging, volatility is spiking, and recession odds? Goldman Sachs just raised them to 45%. In the middle of this storm, one voice stands out, Bill Ackman. Once a Trump critic, now a supporter, Ackman isn't sugarcoating it. He called the new tariffs massively disproportionate and warned they could spark a self-inflicted economic meltdown. And while most investors are panicking, Ackman is making bold moves. His hedge fund, Pershing Square, just dropped its first quarter 2025 filing, and the changes are jaw-dropping. He trimmed two of his longtime positions, Chipotle, down 20% this year. He cut 14.44% of his stake. Hilton, down nearly 15%, he slashed 26.18%. But that's not the headline. Ackman increased three other positions significantly and made a brand new bet on a stock he'd never touched before. That stock? It's up 125% year to date. Let's break down all four of Ackman's boldest moves and spotlight the one stock defying gravity in 2025. Number 1, Hertz Global Holdings. While most investors ran for cover, Ackman went in. He opened a brand new position in Hertz, right as it posted a quarterly loss and missed earnings. But here's why. Under new CEO Gil West, Hertz is in the middle of a full transformation. In 2024, they swapped out over 60% of their fleet for newer vehicles, dumped underperforming assets, and shifted focus to retail car sales. They're no longer just a rental company. They're becoming one of the largest used car sellers in the country, backed by smart tech and digital platforms. Turnaround times are faster, utilization is rising, and partnerships with companies like Palantir are streamlining fleet operations. Their goal? Drive down monthly depreciation per vehicle to under $300 and push revenue per unit above $1,500. They've still got legacy issues from 2023, but liquidity is strong, $1.8 billion in cash. With travel demand growing and high-yield segments expanding, Ackman sees Hertz as a beaten-down brand transforming into a tech-powered mobility giant. Seaport Entertainment Group, or SEG. This one's surprising. The stock is down 34% year-to-date, but Ackman doubled down. He boosted his stake by 139.84%, now owning over 5 million shares, nearly 40% of the company's total float. So why bet big on what looks like a sinking real estate play? Because Seaport isn't just holding property, it's evolving into a hospitality and entertainment powerhouse, spun out of Howard Hughes in 2024. They're unlocking value in premium real estate across New York City and Las Vegas, especially the Seaport District in Manhattan. With landmarks like Pier 17 and the Tin Building, they're turning underused food halls into high-margin culinary hubs and introducing immersive experiences like Meow Wolf, which could draw over 1 million visitors annually. They're optimizing concert venues, revamping restaurant operations, and tapping into Vegas sports and real estate projects. With $168 million in cash, minimal debt, and a clear roadmap to profitability, Ackman isn't betting on what Seaport is today, but on what it's about to become. Nike, NKE, yes, Nike. Shares are down 25% this year, hurt by tariffs, weaker consumer demand, and falling sales globally. Most investors ran away. Ackman leaned in. He increased his stake by 15.29%, now holding nearly 19 million shares worth $1.42 billion, making Nike one of his top 3 positions. Why? Because Ackman isn't betting on short-term headlines. He's betting on long-term dominance. Even with a 46% tariff on Vietnamese imports, where Nike makes half of its U.S. footwear, the company remains a global leader. Yes, revenue dropped 9% year over year, and net income slipped from $4.2 billion to $3 billion. But that's not a structural problem, it's a temporary storm. Nike's brand power, innovation, and global reach haven't gone anywhere. And with shares now trading at 2018 valuation levels, Ackman sees this as a once-in-a-generation opportunity to buy a blue-chip icon at a bargain. Brookfield Corporation, BN. Ackman's largest holding by value. Despite being down 13.3% year-to-date, he added 6.5% more, now holding nearly 35 million shares, a 15.83% portfolio weight. Brookfield is often called Canada's Berkshire Hathaway, with over $850 billion in assets under management. They invest in real estate, infrastructure, renewables, insurance, and private equity. Critics say it's complex. It's been hit by rising rates and tariffs. But Ackman sees through the noise. Brookfield's firewalled balance sheets, recurring cash flows, and global income streams give it resilience that few others can match. Credit agencies still rate them A- with a stable outlook, and their long-term track record of compounding capital speaks for itself. In a market chasing hype, Ackman is going the other way, choosing defensive scale, hard assets, and reliable income. So what's important? While Wall Street is panicking, Bill Ackman is positioning himself for what comes next. From a rental car reinvention to a real estate revival, a blue-chip comeback, and a global asset fortress, he's betting big on transformation, resilience, and long-term value. If you found this breakdown helpful, make sure to like, comment, and subscribe for more deep dives into the moves that matter. Your next big opportunity might already be in motion.